Hello and welcome to The Road Already Traveled, a podcast where we feature lessons from successful entrepreneurs and the professionals that serve them as they share their inspiring stories and insights. Now, let's get started with the show.
Hello, I'm Rich Schutte, your host of The Road Already Traveled, where we share lessons from entrepreneurs, like-minded business owners, and the professionals that serve them, providing valuable insight to our listeners that are on the same journey. This episode, again, is brought to you by Avalan, a wealth management firm dedicated to personalized financial, business, and investment planning for entrepreneurs as they make their way in our chaotic world. Are you ready to take control of your financial future? At Avalan, we believe that wealth isn't just about numbers. It's about freedom, security, and living life on your terms. Wherever you are in your entrepreneurial journey, our team of experts is here to guide you every step of the way. No cookie-cutter solutions, just smart, personalized strategies designed for your goals specifically. Our unique Optimal Entrepreneur program and unwavering focus on world-class service. Our relationships are built to last generations, helping clients achieve their lifelong goals through a thoughtful and consultative approach. Visit avalanwealth.com today and start building the future you deserve. That's AVALAN wealth.com. Today, we're going to dive into a quarterly series that we're going to be posting every 3 months, commentating on the markets and the world around us from an investment perspective. And joining us today to help us do that is Avalan's CIO, Peter Madlem. Peter has been with us now for several years as our Chief Investment Officer and brought to the firm over 35 years of high net worth and institutional investment experience. He's built multiple platforms where he's served for multiple different banks and investment solutions as CIO for Regional CIO for Northern Trust, and most recently, before joining Avalan, had built the entire wealth management division for Montecito Bank Trust here in town. Peter, welcome, and thank you for joining us to talk about the world as we see it over the last quarter and kind of what we're seeing for the next few months going into the future. I know there's a lot to talk about, from conversations around interest rates to trade deals and homeownership numbers, as well as where markets are headed. So I'm going to kind of give you the reins here to talk about what you think is pertinent for the entrepreneurs and clients that are tuning into this particular podcast, just to be able to hear what you're thinking from the top.
Well, thank you, Rich. It's always a pleasure to be able to speak to clients and potential clients and anyone interested in market dynamics, because it certainly hasn't disappointed this year. This was an interesting year because it actually validated the dictum, just stay the course. For instance, there's internal and external technical and fundamental indicators that most professional investors or serious investors follow to give themselves an indication of where markets are and where they're going, be it interest rates, currencies, commodities. And this year was one of those that caught all of the technicals, both internal and external, off guard because of its rapidity. For instance, on April 8th, the S&P 500 had fallen 18.9% for the year. Well, the technical indicators, it was too quick of a decline in the markets for them to pick up. And the fundamental indicators, it was way too slow to get back into the market, because at the end of the first half, that had turned around where the Dow Jones was up 3.6%. The S&P 5 was up 5.5%. That's a massive and rapid turnaround in the markets. Those who just stayed the course and had a good risk-controlled portfolio construction did just fine. And with those who didn't, it's very difficult to get back in when these types of things happen, because you feel so insecure and off balance about what you've just experienced. What's going on in the markets now is that we've got the Trump trade blitz, and we have an increasingly dovish Fed, and then earnings momentum. And so let's start with Trump. He figuratively dropped the mic on trade And now he's racked up 33 trade deals since his inauguration, including the UK, China, Vietnam, Japan, and the entire European Union. In fact, the EU pact hit the headlines yesterday, a couple days ago. And it's big. They'll buy $750 billion in U.S. energy and invest another $600 billion onshore, pay a flat 15%. And this is an equivalent retaliation tariff warfare that we're seeing now, that Trump hiked America's baseline tariff to 15%, but most partners are actually lowering their tariffs or spending more on American goods and investing on U.S. soil. And the goal is to juice $400 billion a year in tariff revenues. And that's real money in the fight for the federal deficit to bring out of control.
Yeah, let's pause there for just a second, because, I know there's a lot of politicization, right? And a lot of emotion that are flying around, these trade wars, if you will, and these tariffs. As a matter of fact, you had mentioned the S&P's rapid fall in early April. That really came on the heels of the president digging in on these trade deals. And I'm interested to is how that's playing out part of the recovery of the market from those initial announcements. But as I ask that question, I also want to make sure that we're not sitting here to take sides or favor one person or another, or one party or another. It's like, we really want to approach this just from a this is what's happening and this is how the market's reacting to a perspective. So make sure that everyone's clear in the fact that we don't really have a horse or dog in this show, but we're just kind of looking and talking about what's literally happening around us and how that's driving markets. So was it the trade issue that drove us to that rapid decline, and how it's beginning to resolve itself that's fueling things forward since?
Yes and no. What's interesting is that it would be really wonderful if we could have a blue chip economist come out and say, and apologize to the American investor and say, I was wrong. Because I think since the inauguration and the announcement of tariffs and the rather clumsy way that it was brought to the fore or implemented, we had all of the classical economists saying that, well, one, we're going to enter a terrible recession by March, or we're going to have stagflation, or we're going to have runaway inflation, or the global economy is going to just collapse because of the imposition of tariffs, none of which so far has come to pass. In fact, the economy now, we're in earnings season, we're still seeing double-digit earnings growth. So we're really in uncharted territory regarding the tariffs and the impact on the global economy. I think what it's really shown us so far and what the markets reacted to was, wow, maybe we were being charged too much for a lot of the goods and services and manufactured goods that we were importing, because companies on foreign soil can still afford to pay a 15% tariff and still make a profit. So that's a very interesting discovery. But then again, what Trump is doing is unwinding the whole post-World War II American aid and global recovery from the ravages of the war. And I think it's time that we do reconfigure that. The quickest way to do that is to start imposing tariffs. So Friday, we should see the jobs report, and that will reinforce whether we still have a solid labor market. And Powell is getting ever more dovish as he's starting to experience quite a bit of pressure, political pressure. I don't think it's a good idea for Powell to lower rates. I mean, I understand the argument for lowering rates. It lowers our cost. Our debt now is $37 trillion and a rather high interest rate cost as we sell our bonds to cover it. But unfortunately, we're running at a CPI of 2.7% with a 2% target from the Fed. He's in a pickle, and I wouldn't want to be in his position right now. But
talk about that 2% target. Is that, that's become a very real number, right, over the last several decades, right, in terms of being there or lower. Is that a healthy number?
Well, it is, because it makes our spending affordable. So, but once you get above that level, then all of these programs that we have, safety net programs, social safety net programs, et cetera, become untenable. They're not affordable. And then you destroy your balance sheet much quicker at anything above 2%. And that's the issue that we're facing now. The Trump agenda seems to think that we can grow ourselves out of debt. The other side of the coin says, no, we have to cut spending. And there seems to be no middle ground. No one wants to cut spending. And only half of Congress at this point is interested in lowering tax rates. So it's, but it could work, but it would probably take 4 to 6 years in order for us to see real results from growing out of. But we're starting to see that now with the promises of investments on the U.S. soil. And the fact that we're bringing in so far $400 billion from tariffs in the first half of the year. That's by the end of the year, you're putting there at $750 billion, that's a pretty significant hit to the deficit.
Yeah. Well, the spending thing is a real conundrum as well. So, I mean, not only is Powell in a pickle, but the more we spend, the more we also tend to add to the inflationary numbers, right?
That's right.
And I don't think I've ever met a government that wants to cut spending. They sure like to keep giving benefits to their constituents, regardless of which side of the aisle they're on.
The CBO scoring, which is a neutral party that scores potential congressional spending, they do not include. It's an antiquated model or an outdated model. It does not include potential benefits of tariff income. And so that's one of the interesting side effects of in uncharted territory. We're not getting true numbers or indicators of what we can expect going forward either. Where we are getting true numbers is in the current earnings season. We're looking at Google. They came out first with they beat, and the other tech titans will probably follow. So earnings are climbing again. Forecasts are climbing again out to 26, and forward EPS currently tracking $300 a share by year end. So a 22 PE, forward PE, that means S&P at 6,600 by the end of the year, and at 23x, which is not improbable, we're looking at close to 7,000, 6,900 on the S&P. That's a melt up. And it's no longer just theoretical. We're seeing the actual numbers to validate that forward looking. And we've been saying 63 to 6,600 by the end of the year here at Avalan. And now we're going to be adjusting that upward, 6,600 to 6,900. So corporate America is doing fine, and it's being driven by spending. Spending continues.
Do you feel that that these earnings are going to be able to keep markets stable, as the markets are certainly been wanting to price in, an interest rate cut by the Fed, right, to where it's being fought for, from the White House side, and Powell seems to really be sticking to that 2% number, and we may not get those interest rate cuts. So if we don't, do we still see that momentum in the market carrying forward because of earnings?
Yes, but we're reaching a pretty important inflection point with inflation. We cannot see it go any higher, and otherwise it would start impacting spending and the consumer behavior and profitability. So, but Rich, we're halfway through the decade, and the U.S. economy is still running at full throttle. So we've had a lot of policy potholes and geopolitical speed bumps and consumer demand powered by my generation, the boomers, and business investment is keeping the engine humming. Even Trump's tariff-heavy trade regime so far hasn't derailed it at all. So the real headline is, if the pace holds, the S&P 500 could hit 10,000 by the time we toast the start of the 2030s. And that would not be a top. It's just be a milestone. So momentum this strong doesn't turn or stop on a dime. And
absolutely fascinating.
Yeah.
What else do you see directly in our rearview mirror or directly in front of us? Are there other things that listeners should be keen into in terms of what they're looking at or what they should expect?
Well, do watch the Fed. Harkening back to my basic training days, when you're trained how to fight a war or survive a war, they the methodology, which is very effective, is first you tell people what you're going to tell them, and then you tell them, and then you tell people what you just told them. It's a very effective training methodology that the military has perfected. So I'll just review quickly our portfolio, the macro basis of our portfolio construction right now. On the economy, the global economy is showing a notable resilience, with recession chances just waning. Risks include monetary and fiscal policy uncertainty, so you have to watch both of those. And then a potential global trade war, which is becoming less and less every day now. Sticky inflation, which we have to watch, and an easing China growth story. It's very difficult to tell what actually is going on in China, though. And then on fixed income side, here at Avalan, we're at 105% of the benchmark duration, so we're at about 6.2% duration, and or a 6.2 duration. And we expect the yield curve to steepen. And we're overweight mortgage backs, we're underweight commercial mortgage backs and asset-backed securities. And we also favor European peripheral debt in core markets. And we're market weight everything else in the fixed income space. In terms of gold, which is up over 48% year to date, we're currently remain bullish for gold. And on currencies, bearish the US dollar. Trump talks the dollar up, but I really think he wants a weaker dollar. We're bullish on the euro, the yen, and the UK pound. And so those are what we're watching, those indicators, and those are the macro basis for our portfolio solutions at this time.
Great. I think that that's certainly useful for our listeners to at least understand where we're coming from. I have a question that popped up in my mind as you were talking about some other things. You know, earlier on when you were speaking of basically unwinding the post-World War II environment, right, that we've been operating in now for decades. Mm-hmm. How do you see that impacting the overall world, right, internationally? I mean, do you think that we'll start to see a strengthening in the West, you know, up and down all of the Americas, or do you think that the Latin American countries are going to remain troubled for some time, or do you see them strengthening as we go about these acts?
This remains to be seen. What actually has happened is we've completely unraveled the post-World War II trading order and economic order. And so now every country, including the NATO countries, emerging markets, they all realize that we've returned to the jungle. It's every man for himself. And so now they realize that, good grief, we have to build up our own defense. We have to invest in our own infrastructure. And so it's going to cause a flurry of debt issuance and a flurry of activity to increase defensive capabilities around the world. So Pax Americana will no longer be the case. We'll have our allies and we will have our not so friendly partners, or actors. And so that's essentially what we're going to be seeing globally now going forward. The era of globalization is done.
You know, I've always been very interested in how the U.S. really reshaped the world, right, post-World War II and our role in it. And for those of you that might be interested in that, there's a book that I read years ago by Peter Zeihan, Zeihan. It's called The Accidental Superpower. It's an intellectual read, but you know, perhaps this conversation might spark your interest in checking something out along those lines. And the post-World War II reconstruction of the world was a big part of it, in addition to geography and other issues. But truly a fascinating read if that's something you guys wanted to check out on your audiobooks.
Well, you know, it's Rich, you raise a good point when you in the question. And despite simmering trade war below the surface, it's going to inflict more pain on our trading partners than on the U.S. And that's why the U.S. is referred to as the hottest country now, simply because we are the consumer base for all global trade. We will suffer actually the least of all other economies. So, and particularly will be aided by a weakening dollar, growing talk that American exceptionalism may be fading that's all. Those are all points that have to be taken into consideration, because we will actually feel much less pain, in particular to the emerging economies.
Yeah, we can definitely debate whether or not we're exceptional or not. But one thing that's not up for debate is that many thanks again to the boomer generation. We are certainly exceptional at consumer spending.
That spending.
Yeah.
Yeah. The most successful portions of the market for the entire year have been commodity related. And now, as we switch to back to nuclear power, which has been forgotten here for 40 years, and the technology has just leapfrogged. So uranium has done extremely well. Gold, obviously, silver has done well. Agricultural commodities, rare earths, all of these have just been phenomenal investments. And that's where we've been specialized primarily in our thematic portfolios. And that story will probably continue for quite a while with the falling dollar and with the reconfiguration of our global trading partners.
Absolutely fascinating. Well, hopefully this gave everyone some food for thought and some good insight in terms of where things have been and where we see them going. Make sure that you hit like and subscribe to The Road Already Traveled. You can find it on any of your most popular podcast platforms as well as on YouTube. So you can continue to tune in to this once a quarter update on the financial markets around us. Peter, thank you for your time today.
You bet.
For all of you listening, we appreciate it. You're a great audience, and we will look forward to seeing you the next time on The Road Already Traveled.
As always, thanks for joining us on the Road Already Traveled podcast. We're grateful you've joined our community and look forward to seeing you again for our next installment, so be sure to click subscribe so you won't miss a thing. This communication is for informational purposes only and does not purport to be a complete statement of all material facts related to any company, industry, or security mentioned. This material is limited to the dissemination of general information pertaining to its diversified services. The opinions expressed reflect our judgment now and are subject to change without notice and may or may not be updated. The information provided, while not guaranteed as to accuracy or completeness, has been obtained from sources believed to be reliable. Financial planning, advisory, and/or consulting services offered through Avalan LLC, a registered investment advisor. Prospects or clients who take advantage of any free consultations or services are under no obligation to hire Avalan LLC as their investment advisor. Listeners who are not market professionals or institutional clients of Avalan LLC should seek the advice of their financial advisor before making any investment decisions based on this communication. Additional information on any securities mentioned is available on request.